Hello, everyone. Thank you for joining us today for our latest On Point webinar. Today's esteemed panel will be discussing where are we now and where are we headed. It's really hard to believe that we're already in the mid-year point of 2021. And with so much continued unprecedented, there's that word again, unprecedented, activity happening in all the business lines we serve, time is truly flying. And I hope the next 45 minutes here will fly as well as we get the insights and perspectives from those panelists joining us today. I'm Kirsten Petrus, the Executive Sales Director here at Oak Street Funding, and I have the pleasure of leading our sales team as they work with borrowers like yourself to strategically use debt to grow their businesses. And today, in July of 2021, I am delighted to moderate a conversation with our well-regarded powerhouse panel of experts as we look at where we've been, where we are, and where we're going. So of course, like with all the webinars you've joined since most of the country's gone virtual, there are some housekeeping items. As a courtesy to other attendees, your phone lines have been muted, but we do welcome and greatly encourage you to use the Q&A interface to submit questions during the next 45 minutes. We've already received several questions and anticipate many more, so we will do our best to answer all that time allows. But given the time, for those that we're unable to answer today, a member of the Oak Street team will reach out to you personally. This meeting is being recorded, and within the next couple of business days, you'll receive a follow-up email with a link to today's webinar recording, as well as the panel members' contact information if you'd like to continue a conversation with one of them. As mentioned, welcome to today's On Point session, Where Are We Now and Where Are We Headed? Today, I have the pleasure of sharing the screen with Oak Street Funding's own founder, CEO, Rick Dennen. Rick brings a perspective not only as the leading lender to businesses like yours, but also as a business owner like yourself. Phil Whitman, CEO and President of Whitman Business Advisors, a national consulting firm specializing in succession planning, M&A, and practice management strategies for CPAs and CPA firms, to name just a few of the things that his team offers. Harrison Brooks, partner at Reagan Consulting. With a focus on serving clients in the insurance space, Reagan Consulting supports clients in M&A, valuation, strategic capital needs, and a variety of other services. And finally, David DeVoe, founder and CEO of DeVoe & Company, also offering a variety of consulting, M&A, valuation, investment banking options, to name a few. Through those services and many others, DeVoe & Company has grown to be one of the leading strategic advisors to RAs across the country. Welcome, gentlemen. And as we get started and kick it off, given our topic of what got us here and where are we going, David, I'd love to start with you, given that your most recent deal book hit my inbox, as I'm sure many other inboxes this morning. So as you sit in your home office still today, in the middle of 2021, navigating an incredibly robust acquisition environment, and you reflect on your own experiences with the businesses you serve, what are some factors that have contributed to us getting to where we are today?
Yeah. Well, of course, I bent over backwards to make sure it came out the morning of this webinar, just to ensure that people had stuff hot off the press. And the press is pretty hot. What we talk about in the REA M&A deal book for this quarter is we crossed a century point earlier than we've ever seen before. 100 transactions within the REA spaces, transactions 100 million or more. 6 months into the year. This is unheard of. As a matter of fact, last couple years, record years, we've been seeing September when that occurs. And I think it was 4 years ago, we didn't even see 100 deals during the entire year. So contextually, two things I'll talk about. We can elaborate on others as well. Well, on one hand, we have mergers and acquisitions in this industry that has methodically increased. We're on track for our eighth successive record year of M&A activity, 1 year being higher than the other. And I think, I think 2021 is going to end up being quite a blockbuster. We've had a little bit of a slowdown the last couple months, but everything we're seeing anecdotally, the number of sell side engagements, even buy side M&A work that we're doing is just higher than it's ever been. But I think, you mentioned COVID, and that's an interesting element as well. When COVID hit, let's say 14, 15, 16 months ago, back in February of 2020, I didn't expect we'd have a record year of M&A activity. Matter of fact, we predicted, and we got this one right, is we'd see this lull of activity and then a surge of activity before we move back to a new normalcy. Well, that's precisely how it played out, even on a faster timeline than we expected. It was a couple months of slowdown as opposed to a couple quarters that I would have probably expected. And then this surge ended up kicking in pretty aggressively. We'll talk a little bit later about billion-dollar plus firms. The billion-dollar plus organizations were what led the charge. When COVID hit, REAs were wired to take care of clients. And that's exactly what this community did. And as a result of that, most of them couldn't focus on mergers and acquisitions. Now, if you're a larger firm, a billion or more, and you have a professionally managed staff, a full-time CEO and COO and head of marketing, your team is not focused on taking care of clients, and you can run your business. You can focus on mergers and acquisitions. So what we're seeing now is a number of dominoes that have been falling. First, those mega deals kept getting done, then the billion-dollar plus deals. Now we're in the midst of about $500 million deals getting done, and we'll see that continue. The smaller deals will start coming up through the rest of the year.
That's great insight about that owner-operator type ability to serve their clients and their business at the same time, right? And they triage the clients, which is the most important factor of their business. Phil, when you look at the design of a CPA firm and the impact of shifting and moving tax deadlines that have recently occurred, the PPP involvement of the CPAs to help their clients navigate that for their businesses, what are some factors that you saw kind of going into where we are today that got us where we are for CPA firms?
Yeah, sure. Thanks so much, Kirsten. And I just want to comment on what David said, because there's a significant contrast between what we've been seeing in the CPA firm arena. As you mentioned, with a change in deadlines, typically on the M&A side, it's heads down, nose to the grindstone from January until April 15th. And then all the small firms get into that mode where they'll take meetings, exploratory meetings. But what happened during the initial phase of the pandemic, many of these firms, number one, had to figure out how to work from home. They weren't prepared to work remotely. Now, the deadline being changed was a blessing for many of them because, as you said, Kirsten, the PPPs, the significant involvement of the CPA firms in helping their clients get the PPPs. Now, CPA firms, most of whom I've chatted with, had record years. They themselves got PPPs, and they had the smart ones generated additional revenue by billing their clients for help with the PPPs. Some of them did not. They just did it as a value-added service. But I think there was a convergence of factors that helped get us to where we are. Number one, there's a disproportionate share of baby boomers that are in the public accounting profession. Probably 70 to 75% of practitioners that are members of the AICPA are of retirement age or within the next 7 to 10 years will be eligible to retire. But as we know, many of them continue working, some of them forever. I think the work from home brought additional challenges. Now, think about this. Your employees are at home, and if a recruiter calls them, they can very easily take a call. So retention of staff was top of mind. And how do you maintain a culture within a CPA firm, or for that matter, any business when you don't have people walking down the halls and having coffee clutches at the water cooler? So there were significant challenges. And then I think new buyers coming in, I think has also changed, the construct of what deals look like in the CPA firm arena. But the one thing I would say, the shift in the deadlines where we normally had from April 15th until the end of August, the deadline in 2020 was moved to July 17th, I believe. We literally had from July 17th till August 31st, 45 days. So whereas, David saw a significant uptick in the RIA arena, we saw a significant downtick and then a race at the end of the year to try and get things done by 12/31. And we'll talk about where we are now, which is significantly different than where we were in 2020. But thank you, Kirsten.
Thank you, Phil. Harrison, I'll come over to you. I started here at Oak Street in 2011 in a role where I was primarily focused on working with our insurance clients, and that was the forefront of all the insurance activity. And while we'll get to it later during this period of time together, when you reflect on how the insurance industry has moved around, what have been some contributing factors that got this business line to where it is today?
Yeah, Kirsten, great question. That's where I would say I would wind the clock back to 2009, because that's really what got us to where we are today. So the Great Recession, everyone was worried where the world was going. And insurance brokers and agents have a wonderful business. It's recession resistant. The fun fact, the agents and brokers declined at 2% during 2008 and 2009. 2% growth. That they declined only 2%. And so what did that do? That opened the doors for institutional capital in our space, private equity. And they said, hey, this is a great business. It's got recurring cash flows. You can put debt on it. You can leverage the asset, and it's recession resistant. And so what we saw is this influx of buyers, private equity. It really started to come in around 2010 and 2011, Kirsten, when you came, and they were 6-7% of the buyers in 2009. Today, as we fast forward to 2021, private equity is over 70%. That's what we're projecting for the end of the year of the buyers in our space. And to David's point, record numbers of M&A activity, same exact trend in our industry for insurance brokers and agents, just a little kind of later stage in the sense of we've seen consistent year-over-year increases in deal activity. 2020 was a high watermark, a lot of that being driven by the election, potential changes in capital gains. And then because that kind of got moved out a little bit, we're seeing 2021, the activity we think will be even higher than 2020. And so that's a lot of the contributing factors of what got us here today. But the fundamentals remain strong in terms of interest rates are low. There's a ton of buyer demand, and the businesses there's 35,000 insurance agents and brokers with an average age similar to what Phil said. The average age of an owner in our industry is 57, 58 years old. So as they look out to the horizon, that's what's generating a lot of this activity. And so that's kind of what got us to this point today. And I'm excited to talk about, I think if you follow our space, you've heard that story before. But what's really fascinating from my perspective is where does it go from here? So I'm excited to be here today and also learn from David and Phil and their respective industries, and excited for the conversation. So thanks for having me.
Thanks, Harrison. Hey, go ahead, Rick.
Follow-up question to Harrison there, on his stats, and I'm assuming that your aggregators, when you talked about the number of transactions, the percentage, you are including the aggregate in with the PE sponsors as far as number of transactions. Is that correct?
Yeah, Rick, and what do you mean by aggregators? Define that term for the folks on the phone.
Yeah, I mean, it's a platform that is backed by a large, capital sponsor, typically private equity sponsor, that is put in place to realize the synergistic benefits of consolidating a bunch of different, channels exist in the insurance space so that they gain the efficiencies.
Yeah, that's exactly right. So the 70% number I referenced, for the folks on this call, that's, your large private equity backed insurance brokers. So Hub International, USI, yeah. So that's who we would be referring to in that group. It's not necessarily just, John and Joe's private equity firm coming in and buying an insurance agency. It's really a private equity firm has made an investment in that space, and they are bolting in and folding in smaller acquisitions, to generate returns. And so, and
Yeah.
I would say that fact that 700 kind of transactions that I'm referencing, that's just reported transactions. So for every one reported transaction, there's probably another transaction that's not reported, because a lot of buyers in our space now, it's an interesting tact, do not announce their transactions. The promise to a seller is nothing changes. Your customers don't even have to know. In some cases, your employees don't even know that your business has been sold. So it's very interesting phenomenon that's kind of occurring there.
Yeah, so to kind of close this question out, I think, Kirsten, to sit and listen to this esteemed panel that we have today, and thank you all for joining. I mean, to David's first comment, our largest quarter was the second quarter last year, and it was because of two large transactions that had the infrastructure to get those deals done. To the available capital, that Harrison referred to. I mean, we've seen this in the insurance space. The aggregators came into these wonderful recurring revenue platforms, and we think the insurance industry is 3 to 5 years ahead of where the RIA space is relative to the timing they came in. The demographics in these industries are almost all the same, and I've heard Harrison talk about them. Phil, and I know David knows him as well, but it's, the age, the number I recall is 70% of the insurance agents and RIA professionals are over the age of 57 years old, which just plays right into succession. But so, you talk about interest rates. I think the biggest impact of a lot of the things that's going to have an impact on activity, Kirsten, is taxes. And the looming changes that exist for 2022 is going to cause a acceleration in the deal flow that occurs in the third and fourth quarter. I was on the phone last night with my brother, who is working for a PE firm, and it's discussions every day around being able to exit transactions in 2021. So, the impact of that, I think, will accelerate here. I think we quickly caught up, as David can prove out in his numbers in the RIA space. It jumped back in the third and fourth quarter and set records in 2020. But there's probably going to be a short pause as well for the acceleration of the 2022 deals that possibly get pushed into 2021. So we'll see where it goes. But I think all of the points that were discussed here are spot on.
Well, and to all of the points that you made, I mean, it's all about activity and ownership transitions occurring, some on a one-to-one basis, some on a very corporate level basis. And all of that is driving a market and an appetite for the market. So the first question we got from somebody who registered today was about multiples. And to a comment you had made, David, the question is, where are multiple ranges today on earnings for a healthy and organically growing RIA that's at the $1 billion AUM level compared to where it was 2 years ago? And then, as you have a chance to answer, Phil, I know that in the CPA space, it doesn't necessarily trade in the same manner. So I would be curious to hear how you see the CPA multiples playing out, where we are now and where you see them going with this anticipated activity. But David, specific to that larger RIA firm, what have you seen over the last couple of years?
Good, good. Well, I'm going to start with my usual spiel about you should never use multiples to value your firm. You don't want to use math that my 16-year-old kid can do in his head a couple of years ago to value your life's work, or you have your staff putting their life savings in place. So half kidding, it is critical, but clearly we can't talk about a discounted cash flow model live today. So we'll talk about multiples. Yeah, so a couple things, I've been doing this for 18 years now, focused on REA M&A activity. And 18 years ago, for let's say $1 billion firm, it was probably right around 6 to 8 times cash flow if we're using that multiple. And then it ramped up to 2008. We alluded to 2008 and eventually 2009, the crisis. It ramped up to a record high in 2008 at the early time of the year. And by the way, a couple of months later, the very low point, the nadir, as we saw the world compress. and valuations got hammered. And I didn't think it ever surpassed what we saw back in 2008. What we saw is a slow and methodical arc. It took 12 years to get back to that record high. So that's 6 years to get back to an average, 12 years to get back to a record high. But it's interesting the timing of the question. It was about 2 years ago, about probably 20 months ago, that we broke through that record high we had seen so many years ago. Now, here's the interesting elements is back in 2008, there were a lot of sketchy buyers in the marketplace. They didn't have good capital backing. They didn't have great management teams, et cetera. My job, I was at a custodian then, was to figure out who's going to fail and who's going to be around. And my failure column was much higher than we'd like it to be when we're predicting failure. A lot of those firms failed. Today, it's different. And by the way, back then, it was kind of like someone with a lot of money throwing it around and blowing up these bubble valuations. Almost 2 years ago, the game changed. We moved not only through that record high valuations that we saw a dozen plus years ago, but today these valuations are justified. They're defensible. Now, why is that? We alluded to private equity. Private equity is smart money, and it's not just cash. Typically, these folks are coming in and they're helping hiring sophisticated management team. They're thinking very strategically. The buyers in the RIA space today have created sophisticated models that will actually increase the cash flow of an organization, the profitability, and they'll make it grow faster. So if you can make an acquisition and increase the margins and make it grow faster, you can pay more and you can pay more. So despite these record high valuations, I think these valuations are actually justified in today's marketplace for the right buyer. You're selling to someone down the street that doesn't have a mousetrap that can make you grow faster and expand your margins. They can't and shouldn't pay these high valuations. So the valuation's very long preamble to get to the punchline, the question you asked. Multiples for billion-dollar firms. Again, the average for this industry over the last, say, 20 years is probably that, for a billion-dollar firm, maybe 6 to 8 times cash flow, maybe 9. In today's environment, you said a firm that's growing organically. It has a healthy model. It has good margins. It's a healthy business. For a billion-dollar firm, you're breaking it into double digits. You're getting in low double digits for these firms. If you're a billion-dollar firm and you're not managed well, you're probably not getting that. But for healthy firms, you are getting into that zone.
Thank you.
Hey, David, quick question there.
Yeah.
How do you feel with the number of family offices that are the way that they're growing, which what I've read is 300% over the last 2 years? Mm-hmm. Do you feel that they will change the valuations of not only the RIA space, but other businesses because of their ability to hold assets longer?
Well, let's see. So I think there's two components of that question. Let me know what you're alluding to. One is a family office or a multifamily office model where, your organization, the model is to manage the money of these ultra high net worth individuals. And clearly, a lot of them have seen their wealth expand over the last couple of years. By contrast, a lot of these times, these family offices who have billion-dollar, assets that they're managing are making investments in acquirers. They're making investments. They're passive long-term capital that can go out and make acquisitions. Are you alluding to one or both? What's the best way for me to answer?
Both, but I think focusing on the latter would be more directionally towards the multiples.
Yeah. So, right now, family offices are not a major part of the acquiring market. We had Harrison talk about percentages. In the RIA space, about 40% of the transactions are done by those aggregators that you alluded to earlier, Rick. And another 40% are done by RIAs. And then we have, the banks and some others, et cetera. The family office is a pretty small sliver. In some cases, they're backing firms. Savant is one that's backed by some not only private equity, but also really family office money. The family office has made some investments here and there. One could argue, Immigrant Partners has some family office money behind it as well. But it's not a huge part of the market. I think they're curious about this space. They're smart investors. And what they see in the RIA space is really that the independent wealth management model is the very best way to support U.S. investors. It's better than brokerage. I'll be provocative. It's better than, IBDs or wirehouses. It's really the best model. And I think smart money is saying, hey, we want to invest in this model, and we're gonna vote with our pocketbook. So I don't think the effect will be profound Rick, for two reasons. One, they're not a huge part of the market. Also, they are sophisticated investors, and they're not going to just say, "Hey, we got a bunch of money. Let's just throw it willy-nilly at this investment over here." They're going to be very disciplined in terms of the rates of return they expect.
Thank you.
So Phil, along the lines of that example, if a $1 billion AUM is representing something of a certain size, when you look at the CPA landscape, those firms that are of a certain size, how has the calculation of the value or the multiple people are willing to pay changed in the recent past to today for those firms?
Yeah, sure. So I think one of the things that we need to look at is if we look at the top 100 CPA firms in the country, and we all know we've got the big four that are in the billions, and then we've got, I'll call it the global seven. We'll add BDO, Grant Thornton, and McGladrey, all very, very sizable. The top 100 firms in the country to be on that list, the 100th firm probably has revenues in the neighborhood of 35 or 36 million. So we're not talking about many firms. There's a big gap between the billion-dollar big four firms, and then, you know, there's that middle market, and there's a new middle market that's approaching $1 billion. Used to be a cluster of many $100 million firms. But there's something sad that's occurring in the CPA firm arena. While we see tremendous valuation in all these other areas, this morning I read that in the tech arena and the healthcare arena, they're fetching multiples of almost 20x EBITDA, which is just incredible. In the CPA firm arena, we really don't look at EBITDA because every penny is distributed out to the owners. And if someone earns $750,000 a year, there's no EBITDA. Everything's distributed out. They don't look at it like, well, I'm a $250,000 salaried guy, and the $500,000 extra is a profit distribution. Multiples in the CPA firm arena in deals are typically done based upon gross revenues or collected fees. So if we look backwards, 2008, pre-2008, I think we had some of the last big deals where there were multiples in excess of one. You had the CBiz Mahoney Cohen deal, which was one of the big winners. And then you also had where FTI or one of the other big consulting organizations came in and bought Sean Braun McCann. And then the real estate market plummeted. But what you're seeing now are firms, the big firms that are swallowing up these smaller firms. They're starting at a multiple of 1, and it goes down from there. What we're seeing is anything from 0.55 to maybe 1.1 or 1.2. And the 1.1 or 1.2 are really for firms with specialty niches, okay? Business advisory services. If you're a bread and butter CPA firm, do not expect to get a multiple of 1. And the thing that we need to look at is a $5 million firm is not a $5 million firm, is not a $5 million firm. And what I mean by that is I'm working with a 2-partner $5 million firm. They're each 7-figure earners. I'm working with a $5 million firm, okay? And this firm is dropping 30%, 4 partners distributing 1.5 million. I'm working with a $6 million firm that has a sole owner. It's maybe dropping almost 2 million to his bottom line. So if you're looking at top line valuation, you really need to go deeper because, as I said, a $5 million firm is not the same as any other $5 million firm. Valuations in the CPA firm arena are going in one direction, and that's down because the supply of firms that are out there clearly outnumbers the number of buyers. And the fact is, we're seeing non-traditional buyers entering the market. RIA firms, wealth management firms, are now buying CPA firms, or they're investing in them and taking equity ownership in states where you could have non-CPA firm ownership of CPA firms. So the reality is there's a tremendous inheritance out there, and private equity is coming down the pike. We almost had a big deal that occurred earlier this year, but our prediction is by the end of 2021, you will see a significant influx of private equity in the public accounting arena because those multiples are low and there is that recurring revenue stream. So there's a sort of like it's counterintuitive when you think we've got these recurring audit and tax revenues, but the multiples are going down. You know, you would think that a business with the recurring revenue model would fetch higher multiples than what we're actually seeing in CPA firm land.
Well, to your point, maybe it's the calm before the storm with the entrance of these non-traditional acquirers. And if one of those segments is private equity, Harrison, I'm sure you can speak to, in the insurance space with their involvement for so long and the directions those multiples have gone. And, you know, I always have to do a slight time check here. We're only on a couple of questions and we've only got about 15 minutes left. But that being said, Harrison, how do you see the future of the involvement of these institutional acquirers, how well capitalized they are? Where else can these multiples go through the rest of this year with the demand that's coming because of these anticipated tax changes?
Yeah, it's a good question. So I mean, private equity, one, is not going anywhere, right? So they've already, that's before coming to Reagan Consulting. I've been here now 6 years. That was my prior life. So I did work for a private equity firm. And, you know, when a private equity firm raises a fund, they have to deploy that capital, regardless of economic conditions. They've made a promise to their investors, their LPs, to deliver that capital. And so they're not going anywhere. And there's new ones that pop up every day, and I'll get phone calls that's, you know, from a new private equity firm entering the space that says, hey, would like to do this. We just raised a fund. We're going to start investing in insurance brokers. Okay, get in line, right? So what's your differentiating factor? Because there's so much buyer, you know, supply. So demand, even though we're having a record number of transactions, the demand far exceeds, you know, kind of the supply. So prices will hold. I do think that, you know, the rates and the economic environment could suppress pricing a little bit, but the biggest driver of agency valuations is what the public brokers do. So if anyone wants to know where valuation's going, just follow the public insurance broker. So that's Gallagher, that's Marsh, that's Aon, Willis, et cetera, Brown and Brown. And so that's kind of a leading indicator. But specifically, just for, you know, everyone on this call, similar construct, 2008, 2009, 2010, it was about 6 times annual profit or EBITDA for an insurance broker. Today, it's double digits for the most part. Now, there's a distinction between the size of the firm, right? So if it's under $1 million in revenue, not premium, in revenue, that's a different valuation category. When you start to get above kind of $1 million in revenue, you know, you could start to see double-digit kind of multiples paid on profit, and at what margin, right? So, and then the larger firms, you know, Phil, you referenced the top 100 in the insurance space. The 100th largest firm in our industry is $23 million in revenue. So, you know, and that has shrunk. Last year it was $27 million. And that was just released yesterday. So what's happening is the big are getting bigger. We have, you know, we have over $10 billion revenue, billion, not premium, brokers in revenue now in our space. And that list is only growing. So private equity, what's next? How does it impact multiples? We've talked about double-digit multiples. I think the next frontier is what type of private equity investor. The playbook's pretty simple. Private equity comes in, they pay a high multiple, and then they fold in other acquisitions at a lower price, and there's an arbitrage. Well, guess what's happened? The smaller firms, like I just said, $1 million in revenue, are getting similar multiples as those large firms. So that arbitrage opportunity has shrunk. And then the question is, that multiple applied to what profit margin? So agencies are becoming more profitable. And so The profit margins times those multiples are what's driving that kind of top line revenue valuation number you hear. It used to be kind of 1.5 times revenue. Now it's very rare to see something trade under 3 times revenue. And it's easy, you know, and I see transactions that are at 4 or higher. So I think the next frontier is for private equity investors to not just come in and increase margin, but how can they tap into technology? And kind of you see this convergence of insurtech, insurance technology, and traditional brokers, they're colliding. How can we infuse traditional brokers who have legacy systems, they have a lot of staff, they're not growing as fast as they'd like to grow. How can we infuse technology to increase the growth and increase the profitability, which I think drives the multiples even higher? And there's also a scarcity factor, right? So the lower the supply gets, the higher the demand, the higher the prices. So I think prices are holding in our space for sure, if not going higher.
Well, Rick, as a business owner, okay, not a lender to these businesses, but rather an owner who has built and sold the company, what are some areas with all these components in play, what are some areas that business leaders can focus on to enhance the value of their firm?
Boy, there's quite a few there. You know, I think you got to start with, you know, what is your exit intent? Is it to sell at the most high level, to sell to a strategic or a financial? You know, and I heard Phil mention it either when he talked about the number of, you know, partners running CPA firms that haven't invested in the management team, and they're going to be, I heard the word orphaned. You know, I think, you know, there's almost a binary. The way I look at all of these deals is you've got to have a really solid management team. That's always going to be the first thing looked at. If you don't have that, then I think the deal's off. If your buyers don't believe in the management team. But beyond that, you know, the typical characteristics of growth, you know, what's the addressable market? Can you expand products and offerings and things like that? Is it organic growth or is it acquisitive type growth? You're going to look at technology that Harrison just mentioned, and how can you create, you know, operating efficiencies there? And then also the brand. I think those are probably the top, I would say, opportunities to, or areas to focus on to really build enterprise value. And at that point, then, when you're trying to sell it, you know, and a buyer's looking at your pro formas, it's what's the probability of achieving those adjustments and those opportunities as you're laying out there. And I think that's the best way to achieve the growth and the areas to focus on.
So, David, kind of to that same question, as we were talking about these larger RA firms, you have kind of these mid-range firms that are less than $1 billion. What are some things that those leaders can be doing to enhance the value of their firms to command multiples, you know, closer to what you're seeing coming across the headlines?
Yeah. Let's see. So, you know, I alluded to our DCF model. It's a 30,000 cell discounted cash flow model. It's really this elegant work of art to value a company. If you're a nerd like me and you like numbers, it's just this really elegant tool. But how do you like figure out what's most important? Those myriad of different factors that drive the valuation of firm, every single one of them falls into one of 3 key categories. Every single one of them. It's the growth of the organization, the profitability of the firm, and the risks associated with that organization or associated with the transaction. So your ability to drive growth, ideally not by charisma, not by luck, but creating a growth machine that can sustain growth well into the future, very powerful. Your profitability is also, it's like a health check. I spoke with a firm yesterday. They actually they had probably 60% margins, you know, which is really good margins, rich margins. We have some clients that come to us, they have like 75% margins, and they're like, hey, let's sell this firm and margins are only going to go up. And we're like, maybe not. Let's probably not. Let's talk about that. Sophisticated buyers are going to see that that's not necessarily healthy because the margins are so high. It might even be an unhealthy check. Conversely, you know, if your margins are low. So you want to understand the margins and demonstrate ideally expanding profitability over time. And then the final thing, the risks associated with a firm, again, being a nerd, we have 48 different risk factors that we look at when we value a firm. So it's everything from, do you do annual reviews of your employees, or better yet, quarterly reviews or ongoing coaching? Or is it just sort of this vague thing? Do you have non-competes, non-solicits? Do you have a concentrated client that's taking up, 20% of the business? The top 1% of your clients should yield about 8.8% of the revenue of your organization. If you're higher than that, that's a risk. So, starting at the high level and saying, all right, my company, what are the levers I can pull on to create consistent long-term growth for the company, to optimize the valuation, not maximize the profitability of the firm? And then finally, how do I mitigate these risks associated with the organization? Any of those three buckets are going to increase the value of the firm.
Well, the multiple levers is certainly important. Scalability, and nerds clearly running the world right now. So I think that's all okay for people. Keep wearing that badge of honor. The, capital markets haven't always been available to these businesses. Phil, working with CPAs, not businesses that are known for carrying a bunch of leverage or debt. What do you see now that capital is available, and where they may use debt to grow their businesses, or where there may be apprehension to use debt when they should? And then, Rick, I'd love your perspective on this too as a debt provider. But Phil, knowing that the CPAs have a real aversion to carrying a lot of debt on their books, what's your point of view there?
Yeah. So mine is probably counterintuitive to most CPAs that are very conservative, and they're very proud when I walk through their doors and they say, yeah, we've got a $6 million line of credit, but we haven't used any of it. It's there just in case. But in any event, I was working with a firm, a $12 million firm, $12 million of annual collected fees, New York City, multiple offices, tremendous niches, and they were going down the road with a wealth management firm. And initially, the wealth management firm was going to acquire the entire firm, and they were going to put together a separate entity to grow wealth management together. Because when a CPA firm has that wealth management division, they will command a higher multiple on the wealth management component than they will on the CPA firm component. But in any event, what we see is this firm decided, okay, we're not going to sell the entire firm, we'll sell 30%. But what they ended up doing, the wealth management firm said, you know what, we're going to give you $3 million. Okay, we're going to take 18% of your firm or something like that, but we want a preferential payment. As we build this wealth management firm, we want our $3 million back. So I said to the managing partner of the firm, I said, why would you do a deal like that? Historically low rates. You could come to an organization like Oak Street Funding and have single digit, availability of, what do you want? 3 million, 8 million, 10 million. I was chatting with, one of your folks, and he was telling me that they were going back to some of the underwriters, and they were going to see if, they could expand that to, I don't know, 30 or $50 million. But there's a significant opportunity. I don't know if it's going through, but in any event, could you imagine if you're a CPA out there and you come to a lender, like Oak Street Funding, and what do? They say, here's $10 million, and now you got a kitty, and you're able to be more competitive, because the way CPA firm M&A deals are typically done, they're back-end funded, and everyone's doing these back-end deals. How about you take some chips off the table, or you allow the firms that you're acquiring to take some chips off the table, and by having that cash component as part of your deal, you're going to win more deals. Cash is king. And again, with historically low rates, it is just, there's an incredible opportunity for those that are not so risk adverse to owing money, so.
Yeah, and Kirsten, to kind of I think Phil's spot on there. You start with the individual, what's their propensity to borrow, and what's their willingness. And a lot of CPAs just aren't, and I get that. But if you think about the three industries we're talking about here, insurance started out with I remember the old 20 years ago, it was 40, 40, 40, and that's how you pay for an agency. It's just you pay them 40% of the commissions the first year, second year, third year. Then it's a 50% advance rate. Then it's a 70, then an 80. Same thing has occurred in the RIA space, where the cash up front has just increased with each transaction. I think it has a lot to do with competition as well and the availability of capital, as we've already discussed. And I think, to Phil's point, I think the same thing is going to start happening as you get more capital coming in, or aggregators coming into these recurring revenue classes, like a CPA firm. I think the amount of cash up front is going to increase. As a lender, we take a step back and say, okay, how much, we're not going to lend capital that can't be repaid, obviously. So there's always going to be that governor on us. And as well, we've started as an independent commercial finance company, and now we're part of a bank. So you also have a governor on what the regulators, so to speak, will tolerate when they come in to look at your portfolio.
So with all the activity going on in the past couple of years, the whole approach to meeting buyers and sellers has had to change out of necessity, and most of us quickly adapted to a virtual world, hence today, right? Harrison, in the insurance space, do you see any aspects of diligence in the acquisition world changing from 2 years ago to today?
I don't think diligence changes that much. I think, the front end process, maybe you have some virtual meetings as opposed to in person, but you're still looking at the same fundamental things, and you want to meet the folks that you're going to do a transaction with. So I don't think diligence changes, but Kirsten, I think the most interesting thing is kind of the dating process to figure out less about the numbers, but more about the chemistry and the fit. So like when we're taking a firm, there's 50 some buyers in the marketplace. How do you determine, who to partner with, who's a good fit? And we have a series of what's called, chemistry meetings. We're able to kind of slim down that 50 down into, 5 or 10. And then you meet with those folks, and that can be an hour and a half conversation via Zoom to see who you connect with, both strategically and personally. And that's anywhere in the country, right? That's a total game changer. So it allows smaller firms to become more attractive and to speak to more people and open up the marketplace well beyond just their local environment. So it's been a complete game changer in our industry, I think, through COVID. And I've done transactions start to finish, and there's never been an in-person meeting. And it's been over a 4-month period of time. Do I think that continues? No, but it's proven that we can do it. So when schedules are not there, we can be flexible, but I don't think there's any substitute for getting in a room and really getting to know the people that you're going to be in business with and partnering with.
David, has anything with your clients changed in terms of what's important to them and what they're uncovering as part of the diligence process in the last couple of years?
Well, clearly the process has changed, when we went remote, et cetera. So that was a new challenge. But no, I'd say the technical components haven't changed. I think the one thing to be more aware of is just, we're going to release a survey soon, and COVID did have an impact. Rick alluded to it earlier. Everyone on the call has alluded to it to a degree. The COVID impacted this world, and particularly it impacted people. So we saw cultures negatively affected. Spot on, people check those boxes saying our culture suffered. We saw engagement with the firm, which is a very concerning red flag. As Phil alluded to, there's that potential risk of taking calls while you're at home, et cetera. And if you're not engaged, that creates an exposure point. Advisors did a good job. They communicated more effectively and more often with their staff. But the reality is these are impacts that it can have on the firm. So I think as you're contemplating a potential sale or internal succession, ensuring that those lines of communication are open, you're really using it as an opportunity to make people feel engaged. You're tying them back also to the mission, the vision, the values of the organization. At the end of the day, it's the intrinsic side of your organization. why they're there, especially the younger employees, the purpose of what your firm exists for, curiosity, a lot of these intrinsic factors that make people happier, engaging with them, the water cooler isn't there. Those things are even more important than comp or bonuses, et cetera. So your ability to really use this as an opportunity to try to pull the team closer together and focus more on your team's needs and what's going to make them happy will ultimately make them more successful too.
Rick, we talk a lot about here the impacts of corporate culture. Do you think that people making choices of being in office to remote to hybrid will play a role in whether or not a company is seen as more attractive or less attractive to some of these well-funded acquirers?
I agree spot on with what David was talking about there, and I think there's, different generations are going to have different, desires on how they work on a go-forward basis. But couldn't agree more. And Kirsten, you can attest, since we've been back in the office, stuff that might take a month to have 2 or 3 meetings and coordinate time schedules and make a decision. The way that we operate around here, everybody gets together in the couches, right out back here. We talk about it, we make a decision, and you move forward in 2 hours, between training, collaboration. But that's all part of the culture that you're building and the value, that you're going to eventually look to monetize at some point in time, and it's all incredibly valuable.
So Phil, to their point, as they're both mentioning the younger generation, issue across all of these businesses is kind of identifying the next generation of people to succeed in the business, to take over the business in leadership roles and ownership roles especially. And given the demographics you all mentioned, compared to about 5 years ago or so, what are you seeing changing in terms of sourcing of talent, coaching of people, and bringing that next generation up so that these founders or these existing leaders do see a path towards retirement?
Sure, and that's a great question, Kirsten. There is such a challenge today in the talent arena for CPA firms. We're at near full employment, but the thing that firms need to worry about is, as I said, people are still working from home, and recruiters are every day reaching out to your people because they have clients that are willing to overpay. We had one candidate, imagine this, a 3-year senior account, 3 years in the business, just became a senior accountant, earning $65,000, goes into a firm, is offered $85,000, a $20,000 increase, which is absolutely meaningful in their life. And then another firm comes along and increases it to $90,000 or $95,000. The same day offer, same day acceptances. There's a lot of pent up anxiety amongst people. God bless you, David.
Sorry.
Pent up, people are anxious. They've been sitting at home, working at home. Business is very different. Well, one of the things that we've actually done, we've partnered with a company in the Philippines to bring CPAs, attorneys, architects, virtual assistants to all sorts of companies, to clients of our CPA firms. And here's what's happening. We get CPAs that worked in the Big Four. Imagine this, a senior manager that here in New York, you would pay anywhere from $125,000 to $200,000+ for $44,000. I was speaking with a managing partner of a $160 million firm that's based in Atlanta, Georgia, a client of ours. And when I told him what we were doing in the Philippines, he said to me, "Oh, we have a strategic relationship with a company in the Philippines. We may even consider buying that company." He said, "I just hired a manager. I gave her a $4,000 raise. We're paying her $28,000. Think of what that does to the margins. So I think what's happening, there's an amazing.
Hey, let me pause you for a second. Coming from Deloitte, where their audit papers are performed over in the Philippines. Think about the partners that are reviewing work papers of people they've never met. They have no idea how they were trained, and now they're looking at being personally liable for signing opinions. I'm going to tell you, like, the tension between trying to build margin there in that business, but the risk taking by the senior partners is there's a conflict going on right now.
You're absolutely correct. There is that conflict. I think a lot of firms are more comfortable on the nuts and bolts accounting side. You know, India is a place they go to for tax, but again, you know, you absolutely have to measure that risk. You know, one of the things, there's an inheritance out there, you know, because of the demographics of the profession. But there are fewer entrepreneurial folks that have entered the profession. And after 3 years in a Big Four, they think that's all public accounting is about, and they exit and they go into private. So for the past 20 years, we've had this gap in talent, which causes people to work above their level and partners and others to work beneath their level just to accomplish what they need to get done. And the answer for CPAs that want to keep people in the business and create that internal succession is clearly a shorter path to partner. A shorter path to partner. When I entered the profession, it was 12 years and you could become a partner in a Big Four firm. Now it's probably about 18 or 20 years. I mean, it's just crazy. So, and then I think the other thing people need to do in all of these professions is publicize the earning possibility. I don't think young CPAs understand how many millionaires were created by people just being partners in a CPA firm. It's the best kept secret. And it's a secret that's kept because there's fear. If they know how much money we make, they're going to hold out their hand and ask for more. But it's a secret that needs to be shared, especially if we want people to stay in the profession.
Well, to kind of summarize what you just said, is shortening the path to that level of achievement, to having some transparency to what's on the horizon so you actually can keep important employees engaged and focused on achieving that. You know, we're really coming up on the hour here, and there's something really important I want to hear from all of you. There was one economic question that came in specifically, Rick, if you don't mind quickly just addressing, I know we talk about this all the time here, how inflation can have an impact. And then at the end of that, if you wouldn't mind just giving a quick outlook of what you see happening for the rest of the year, and we'll bounce around the screen from there, Rick.
Yeah, I'll hit it real quick on the inflation and let those guys bounce around. You know, I look at these indicators every single day. I mean, there's 3 or 4 really key indicators, all pointing the same direction, from, you know, non-farm retail sales to CEO confidence levels, to the food and ag industry prices. And right now, 40% of small businesses are increasing prices. That's all pointing towards inflation. A recent chart I also saw talked about, is inflation going to be 3% for the next 5 years? That has actually decreased. 40% of the people say that it is going to be at a 3% level over the next 5 years, but it's come down a little bit the last, you know, 2 weeks or something like that. So clearly inflation is increasing. There's concerns about it. People are increasing all their prices. The economy's pretty solid. There's cash available. So
Rick, if 40% are saying 3%, is the majority saying it's going to be higher or lower? What's the over under on it?
I do not have that answer. That's a very good question, Dave.
Interesting. Okay.
David, so where do you see the year wrapping up? I know the deal book was out and people maybe haven't even had a chance to read it yet. In a few seconds, where do you see the year ending up for the businesses you're serving?
Yeah, so I think M&A is going to accelerate. Just seeing our pipeline and knowing what's happened in the industry, M&A is going to shoot up. I think the other key trend, or one of several, is we're going to see divergence and business performance. A lot of those struggles we talked about earlier, some firms are going to do great and are, breaking through COVID, breaking away, and others are really are suffering and challenged. So we'll see some divergence of business performance in the industry too.
Harrison, when everybody says you can't go any more activity going in the insurance space, where do you see the end of the year?
Yeah, it's not slowing down, especially with pending tax rate changes. So there's a growing divide, I think, in our space of size and scale matters and resources and a flight to those. And I think a lot of firms are sitting there saying, taxes are going up. I've got this great asset. And if I don't sell my firm, then I'm making the conscious choice to buy that firm, right? Every day you're not selling the firm, you're making the conscious choice to buy it back internally. And if you're going to do that, you need to be committed to making the investments. And that's not cheap always, right? That's investing in young talent. That's my answer to what's the one thing that an independent agency can do to fundamentally change their valuation is to get younger and focus on sales and increasing sales velocity. So thanks for having me, Kirsten.
Well, as we've hit the mark here at 1:30, everybody that's listening, keep your eyes open. Phil and his team will be presenting at a number of CPA State Society programs on their building advisory services, as well as launching their exclusive boot camps for CPAs. Harrison is happy to let us know that the Reagan Agency Ownership Summit will be coming back in early 2022, so keep listening for more there. David, I'm looking forward to seeing you this October in person in San Francisco at your M&A event, which is always valuable in terms of the information we get out. And Rick, we'll see you soon here for our next On Point session, which is going to focus our own Susie Davis, Treasury Management Specialist, as she talks about the hidden value of having a strong treasury management plan, a strong banking partner, and how it's critical to so many aspects of your overall business cash management and operations. With that, thank you all for joining us for this extended On Point session today. It was great to hear about how things have been, where we are, and where we're going. See you all soon in person. Everybody have a great afternoon.
Thanks, everyone.
Good job.
Thank you.